Picture this. It's 2:47 p.m., New York. You are a trader on the floor. Your screens are red, all of them. The Dow Jones is falling, not 1%, not 5, 1,000 points in 4 minutes. You look at Procter Gamble stock. 1 minute ago, it was worth $57. Now, 1 cent, 1 second, 1 cent. This is not a movie. This is May 6th, 2010. This is the flash crash, the fastest market collapse in human history, and nobody understood what was happening. Not a single person in the world. 14 minutes later, the market would recover. But in those 14 minutes, $1 trillion would simply vanish. $1 trillion. Today we break down how it happened, who triggered it by accident, and why it nearly destroyed the entire global financial system. To understand the flash crash, we first need to understand how the modern stock exchange works. Because it hasn't been men in ties for a long time. It's algorithms. In 2010, roughly 70% of all trades on American exchanges were executed automatically. Programs traded faster than a human could blink. Literally. Milliseconds. And on May 6th, the market was already nervous. The European debt crisis. Greece on the verge of default. Investors were selling off assets. At 2:32 p.m., one firm, Waddell & Reed, decided to hedge its portfolio. They launched an algorithm. Sell 75,000 futures contracts. Fast. Price didn't matter. 75,000 contracts. That's $4 billion in 20 minutes. The algorithm began to sell. Other algorithms detected the selling pressure and also started selling. A third wave of algorithms saw that and sold too. This is called a Cascade Effect. Imagine someone quietly gets up and walks toward the exit in a movie theater. 3 people follow, then 20. A minute later, the whole audience is running for the doors and nobody knows why. High-frequency traders, the very algorithms that normally provide market liquidity, panicked and shut themselves off. They simply exited the game. There were no buyers left. And then came free fall. Shares of major companies sold for 1 cent, because that was the only standing bid in the system. Robot buyers had placed random stub quotes as placeholders, and they were getting filled at those prices. In 4 minutes, from 2:41 to 2:45 p.m., the index lost 9% of its value. $1 trillion evaporated. And here is the most critical moment. At 2:45 p.m., the CME Group Exchange activated a mechanism most people didn't even know existed. It's called stop logic functionality. An automatic circuit breaker. The system detected that the futures market was falling too fast with no real economic foundation. And it simply paused. 5 seconds. 5 seconds is nothing in ordinary life, but for algorithms, it's an eternity. In 5 seconds, high-frequency traders had time to restart their systems, assess the situation, and return to the market. Liquidity returned instantly. Prices began to recover. By 3 p.m., the market had nearly fully recovered. That $1 trillion came back. But not all trades were canceled. Many investors had sold at absurd prices and lost real money. Now for something few people talk about. Simultaneously with the flash crash, at that very moment, British trader Navinder Sarao was in his London apartment running an algorithm that created fake sell orders. He was adding pressure to a system already on the edge. One person, from a one-bedroom apartment, almost brought down the world's largest economy. This was not a movie. It was an ordinary day, and nobody pressed a big red button. The catastrophe was stopped by an algorithm operating without any human intervention. Let's step out of the role play. Let's talk calmly about what happened next, because this is where it gets truly interesting. After the flash crash, American regulators, the SEC and CFTC, launched a joint investigation that lasted 5 months. They analyzed more than 20 billion individual trades from a single day. The conclusion was stark. The market had become too fast for human oversight. Algorithms were trading faster than any regulatory system could respond. What changed after this? First, circuit breakers were introduced, automatic trading halts. If a stock falls more than 10% in 5 minutes, trading is suspended, automatically. Second, regulators introduced minimum order resting times. Algorithms can no longer place and instantly cancel millions of fake orders. Third, exchanges required high-frequency traders to remain in the market during periods of volatility, specifically so that liquidity wouldn't vanish at a critical moment. Navinder Sarao was arrested in 2015. He pleaded guilty and ultimately received a suspended sentence. The court took into account that he had Asperger's syndrome and didn't fully understand the consequences of his actions. The main lesson of the flash crash is not that markets are dangerous. The main lesson is that complex systems always create unforeseen risks, and the only way to manage them is to build safety mechanisms into every layer. TCAS in aviation, IAEA protocols at nuclear plants, circuit breakers on exchanges. All of these are systems designed to work precisely when humans can no longer react in time. The system works because it learns from near misses, from those moments when catastrophe almost happened, but didn't. And every such close call is a costly, painful, but priceless lesson. The flash crash lasted 14 minutes, $1 trillion, and one 5-second pause that saved the global economy. 5 seconds.